Welcome to the Explainer. Today, we're diving into what is probably the biggest shakeup in crypto taxes we've seen yet, the brand new Form 1099-DA. Let's get right into it and break down exactly what this means for you.
So if you've ever bought, sold, or traded digital assets, you definitely know the feeling, right? You're trying to navigate this tax landscape that's been, well, to put it mildly, a huge gray area. Reporting your gains and losses can feel like a total guessing game, trying to piece together all your transaction histories from a bunch of different exchanges and wallets.
And look, that feeling of confusion, it wasn't just you. It was pretty much the reality for the entire market. For years, the digital asset space has operated in what the IRS has basically called a Wild West era, where clear, straightforward rules were almost impossible to find.
Now, this created a couple of massive problems. First, it led to what's called a tax gap. Basically, the IRS was missing out on a lot of tax revenue from gains that just weren't being reported. And second, it left even the most honest investors and traders totally unsure about what they were supposed to do, which, of course, led to mistakes and a whole lot of compliance headaches.
Okay, so to try and fix all of this, the IRS is rolling out a brand new tool. It's designed to bring some much-needed clarity and accountability to the crypto world. And that tool is Form 1099-DA. The easiest way to think about this is that the new 1099-DA for crypto is basically the same as the 1099-B for stocks. You know, if you've ever sold a stock, your broker sends you a 1099-B with all the details. Well, the 1099-DA is designed to do the exact same thing, but for your digital assets. It creates a standard way of reporting that gives both you and the IRS a clear picture of what's happening.
And listen, when the IRS says digital asset, they really mean it. For tax purposes, the definition is incredibly broad. We're not just talking about Bitcoin or Ethereum here. They're including stablecoins, NFTs, even tokenized real-world assets. The bottom line is, if it's on a blockchain, the IRS is probably going to consider it a digital asset that falls under these new rules.
So how does this form actually work in practice? Let's break down the details, the who, what, and when of this whole new reporting framework. First up, who actually has to file this thing? Well, the rules apply to digital asset brokers. And just like their definition of a digital asset, the term broker is super broad. It obviously includes the big centralized exchanges we all know, but it also covers things like payment processors, a lot of hosted wallet providers, and even some of those crypto ATMs. They're really trying to capture just about any company that helps people make digital asset transactions. This form is going to have a new level of detail that both you and the IRS will see. It's going to include the gross proceeds from a sale, the exact transaction dates, and even unique digital token identifiers to keep things straight. And here's the really important part. Eventually, it's also going to include your cost basis. Now, the IRS knows this is a huge change, so they're not just flipping a switch overnight. They're rolling this out in two phases. For all your transactions in 2025, brokers will only have to report the gross proceeds. That gives them a year to get their systems ready for Phase 2, which kicks in for 2026 transactions. That's when they'll have to start reporting your cost basis too. Okay, so with new rules, you know what's coming next. New consequences. Moving from this informal, kind of messy system to a formal one means the stakes for getting things wrong are way, way higher, and understanding these penalties is absolutely crucial, not just for you, but for the brokers you use too. For you, the taxpayer, a big mistake can be really costly. If you substantially understate your tax liability, which the IRS says is understating what you owe by more than 10% or $5,000, whichever is bigger, you can get hit with a pretty painful 20% penalty on the amount you underpaid.
And the brokers are on the hook too. For the 2025 tax year, if a broker intentionally disregards the rules and fails to file a correct form, they could face a penalty of $660 per form. Now imagine an exchange with thousands of users. Those penalties can skyrocket into the millions, which pretty much guarantees they're going to take these new obligations very, very seriously.
But the IRS isn't entirely heartless here. They can waive these penalties if you can prove you had a reasonable cause for the mistake. Now, this isn't just a simple excuse. It means you have to show that you acted in good faith, you did your due diligence, and you really tried to report the correct tax, but you still couldn't comply because of circumstances you couldn't control.
So what does all this really mean for you and your strategy going forward? I mean, this is so much more than just a new form showing up in your mailbox. It's a fundamental shift in how digital assets are treated by tax authorities, and it really requires a whole new approach from every single investor. So here's your new playbook. Number 1, document everything. The days of letting transactions just slip through the cracks are officially over. 2, Anticipate the form. Starting in 2026, you're going to get these forms, and you better believe the IRS will be matching them to your tax return. Any difference is going to raise a red flag. And number 3, track your basis now. You are the one who's ultimately responsible for calculating your gains and losses correctly, so don't wait for the brokers to do it for you.
And all of this brings us to the biggest takeaway. This new reporting system, it really signals the end of crypto's special under-the-radar status. The IRS is making it crystal clear that a taxable gain is a taxable gain. It doesn't matter if that gain came from selling a stock, earning $1 of interest, or swapping one crypto token for another. In the eyes of the law, it's all just in. Which, of course, leaves us with one final thought. With crypto tax reporting now set to mirror the rules for traditional stocks and bonds, this is probably just the beginning. The integration of digital assets into the global financial and regulatory system is clearly speeding up, and it really makes you wonder, what's next?